Hi, I'm Jonathan Bays, and this is November's investment market update.
Over the past month, we've seen the S&P ASX 200 hit 6,000 for the first time since 2008. The main driver for that is actually small and mid-cap performance over the large caps. So the smaller and mid-cap companies have done much better than the larger companies in the Australian market.
It's been driven by, again, continued strength in the global economy. We've got economic momentum across the US and Europe, particularly at about a 10-year high. In China, it's reasonably strong. In Australia, again, we're still struggling to get out of third gear. But markets across the board very good and supported by a really good bond market at the moment as well.
Equity gains have been really strong over the past month, both globally and locally.
But we've also had really good earnings numbers. September quarter earnings season in the United States particularly has been good, and the big tech companies all beat on expectations. Facebook, Amazon and Google all did very, very well.
The oil sector has been going really strongly as well over the last few months.
So it's been an all-round reasonably positive environment for shares, and that's why we are up 7 or 8% in the last couple of months. It's no surprise we've seen a good debut from two recent listings that we participated in, one being the Metrics Credit Trust, MCP Master Income Trust, which has debuted surprisingly really very well actually for a fixed income security, and now trades 5 or 6% above its issue price. That's great. We've also had success with Magellan's Global Trust, where we switched some money out of the Magellan Global Fund and into the trust as a means to pick up loyalty rewards for investors, but also to get access to a more dividend yielding international share fund. And that too is now trading at a significant premium to its listed price. It came on at 150 and it's now at 161, so very pleased with both.
Investors who were eligible and have participated in the Magellan Global Trust issue can look forward to receiving their loyalty units in January next year.
So, I mean, the data, as I've said time and again the last few months, has been fantastic out of Europe and the US. Post the impact of the hurricanes at the back end of the northern summer, the economy's really kicked back into gear there. Manufacturing and service activities, again, still back up at 10 and 15-year highs. Europe remains really strong. I feel like a broken record, but Australia continues to struggle.
Moving towards the new year, there's a couple of things that we're still looking out for in the near term. The markets are currently focusing on the US tax reform.
We're now getting to the pointy end of that, and policymakers look very close to trying to sign a deal for widespread tax cuts in the United States. And that's been a big propellant for small business optimism, so hopefully that'll go through, although it's still, at this point anyway, dicey whether it does.
So the other key thing we're watching for is actually changes in quantitative easing. So over the last couple of months, the US Federal Reserve has announced that they'll be reducing their balance sheet. So what they're doing is they're reinvesting less of their fixed income assets that they've been buying up, or reinvesting rather. And at the same time, the ECB has recently announced that they will be reducing their quantitative easing as well by halving their purchases for the next few months.
On the positive building approvals, which have been a real issue here locally over the last 12 months, have started to turn around. Apartment momentum or certainly apartment orders have started to pick up a little bit again, and we're back at a 12-month high. So that's not bad. The flip side of which is that retail sales last month for September came in with a rise of about 1.5% only, and it's about a 3 or 4 year low in terms of retail sales momentum, and it's actually one of the worst half a dozen months we've had in the last 20 years for retail sales. So the consumer is certainly starting to save their pennies a little bit more of late, and that's not a great thing going into Christmas.
Bond yields are actually a key thing that we will be watching, and we'll definitely be cautious on bond yields, and if anything happens over there, we'll definitely make some moves in terms of the portfolio.
Despite the strong growth, bond yields are remaining really well behaved, and that's providing a really supportive environment for shares.